Up, everybody? Welcome and good afternoon. Just one moment here as I turn off this lovely music we have going. And it is awesome to be here with all of you this afternoon. And my name is Jonathan Mallard. I lead the onboarding team here at Benzinga Pro. And we've got a really special program for all of you today with Nick Shaheen. So I'm just going to share my screen one more time here and tell you a little bit about what we have coming up here today. So, first of all, who is Nick Shaheen? We've got just a little bit about him here. His success rate on tip ranks. I'm sure you're familiar with tip ranks. 68% with an average return of 31.8%. And that's just his stock picks. But more importantly, he's been trading with Benzinga for over a decade now. So he's been working with us for a long time, helping a lot of people learn how to trade options, be successful with options. And it's really an honor just to be able to work with him and learn from him. So we're going to really cover a lot of great stuff today. And here's a little bit about what we will cover today. First of all, we're going to talk about where do we even start thinking about trading? You know, especially in some of the volatility we've seen recently, but you know, there's always volatility in the market. That's how you make money, but there's also risk. So what is risk? How do we define risk? And how can we improve our trading by how we think about risk? Then a little bit of basics about how to think about options. What are spreads? What are credit spreads, debit spreads, things like that. If you don't know that terminology, don't worry about it. We'll get into that. And then how can we trade effectively and protect our capital in a market pullback or a downturn? I mean, lots of people are talking about, is this a bear market? Is it turning around or is it still bullish? And really, you want to be able to be profitable either way. Then we will have some time to cover some tickers with Nick, and you'll learn more about how to trade with Nick on a daily basis. And we do have a little special treat for all of you who stick around. So without further ado, I want to welcome Nick here. Nick, can you hear me okay?
I can hear you just fine.
Awesome. Well, how are you doing today?
Pretty good. I'm still under the weather trying to kick this coronavirus thingy. The market today acted bullish a little bit too much at the end. I would have rathered a nice green day. It didn't need to be as green as it got to be, because the goal is you want to crush the volatility, these big swings, pluses and minuses, you want to stabilize. So I would have taken a big down day in the VIX and a solid plus 1%. We did not need to pursue 2 and 3% upsides. Of course, it's nice to see some greens, because I know everybody wants to be long, is long, tries to catch falling knives. And of late, it's been difficult. So good day all around. We
All
had
right.
we had
Well,
some fun. We had some fun in the live session. Um, some people made some good money. I left some money on the table, but that's okay. So,
you sacrifice a lot for your members, and thanks for taking time out of your day, even when you're feeling under the weather, to be
oh,
here with us. Do you want to share your screen
yeah, I will
and
do that
yeah,
unless
they
you want
want
to
to
look
see
at
your screen
yourself
a
the
lot
whole
more than
time.
my face.
So that's what I'm saying. I hate it when you show my mug up there. I mean, I need an updated version of it anyway. Okay, so what you're looking at is just the S&P chart to keep us, give us as to whatever I do. I always have to start with where do we stand within the market, because regardless of what idea you guys have as to what's going to do what, nothing is going to go against the market in general terms. So if the markets are correcting, regardless of how good my idea is of a bottom in a stock, it's not going to play out. It's going to drag it down with it. Okay, so let's just get to it. Thank you for the overhead. It kind of lays out the process of how somebody should approach investing, trading, whatever it is, regardless of how you do it, options or not. The process is the same. So let's take a scratch pad and start with defining risk. before you take anything, before you do anything, put anything on the line, the number one rule of risk is you need to be able to know what's the worst case scenario. So quantify the absolute worst case scenario. So how much is at stake? What's the consequence if I'm wrong? So that's the first thing I need to know. If I don't know this, I don't take the trade. So it says here, participant cannot see my screen. Can you see my screen okay?
Sorry, I was on mute. Yes, I can see it okay. It might be
Okay.
small for some people.
Okay. It flashed on my screen saying that you guys can't see my screen. Okay. So let's go here. And let's just say that this rule right there stops me from shorting stocks altogether, like the traditional way of shorting by selling a stock I don't own. Because by definition, I don't know how much I can lose because I'm losing for as long as the stock is rallying and until I get the opportunity to cover my short, which may not happen. In hard to borrow stocks, sometimes you're stuck short. So don't short stocks outright. All right, so that's the first rule, is define your how much pain are you willing to take if the worst case scenario unfolds. And when I take the trade, that means I am okay losing that much money and be able to survive. So it should not be a devastating loss that gets you out of the game. That should be a no-no. That's first step. The second step is also defining risk. We're still at what is risk. The second step is what are my odds? So how likely am I to win or lose? I need to know this number. I need to have an idea. So when you think about it, you do it instinctively and you don't think about it. You should think about it and you should give yourself a score. So you do your homework, you find a stock you like, you buy shares, and you hope for the best. You should give yourself a score. What do I think my odds are against my competition? Somebody sold me these shares. Why did they sell me these shares? They clearly disagree with me. Otherwise, why would they sell the shares? So give yourself a percent. Luckily, with options, this number is ready. You can read it off of a table, and I'll show you where that lives. So that makes it a lot easier. That's why I like trading options. It's quantifiable. My risk is quantifiable in size and in odds. What are my odds? So the reason why I can have a success, the way you can give yourself a high success rate is by starting out with an edge. When you open a trade, you can assign yourself odds. You can choose high odds in your favor on every trade. And believe it or not, they're called odds for a reason. They work out almost to a T. So you don't win every time, but if you design it to win almost every time, you're far ahead of the competition. So when it comes to options, you've heard the term, most options expire worthless. So keep that in your head, that the market is out to screw you every time you're out there. The market makers are trying to make everybody lose money. That's their goal. Everybody needs to lose money. If you put that in your head, then you will take fewer risks that are foolish. Okay, so the odds are there for a reason, and the options chain provides us with those odds. And if you have the discipline to take trades that have good odds in your favor, better than your competition, then you will win more often than your competition. And that's as simple as that. But having the discipline to do it every time, that's the tricky part. So we just defined risk. It's two pieces. One, how much am I risking? But that's not a decision I manage. That I make it and I move on. The second decision that I manage is what are my odds of winning and losing? And when my odds drop, like I take a position and I assign myself, let's say 70% chance of winning over my competition. And let's say that 70% drops to 50-50. So now I'm at the mercy of a coin flip. I don't like that. I probably will take the trade off. So that's the kind of thinking that should happen on a continual basis. And you have to go back and revisit. You know, this week might be 70, next week might be 50, might be 80. So you can come back and revisit it. Okay, so that's a little nuance on this part. I want you to get out of the habit of averaging down. It's evil. Averaging down means you've got a problem and you're making it bigger. Averaging down is no good. Averaging in is a much better way. I'll give you an example in crypto right now. I forecasted the drop in crypto, and I think the Bitcoin can be in the low 20s, if not a high teens. So it can revisit the all-time high that everybody thought was ridiculous in 2018. I'm not saying I want it to go there. I'm saying it can go there. So on the way down, I know I'm going to be buying in batches. So I bought the first batch at 33. It bounced. I didn't book it because that I planned on averaging in. So let's say I wanted 100 coins of whatever, Solana or whatever it is, the coin CRO or something. Then I will buy first batch of 30 coins, second batch of 30 coins in the 29,000. And if Bitcoin gets to the low 20s, I will put the rest in. So I'm not averaging down. I planned my entry at different levels just in case I don't nail it, because I think it can go to the low 20s. So I don't want to jump all in now and add more risk at 20s. So I would buy a little bit now, buy a bit lower, buy a little bit lower to get to a full size position that I planned on the beginning. So that's averaging in. Averaging down, somebody would just dump everything in one trade and then double down when it falls apart. That's not smart. Okay, averaging in is smarter than averaging down. Okay, so putting that aside, boom. Let's just jump into options. And this is an options chain. Excuse me. This one is from E-Trade. I'm not recommending it. In fact, I definitely am not recommending it. I used to say, I don't care. I wouldn't use it if I wasn't stuck in it from a long time ago with good pricing. So let's just put that out there. So the contracts, the options chain is made up of contracts. So options by definition are contracts between buyer and a seller. So just like any contract, forget calls and puts, you may have heard those terms. Just like any contract, it has terms, and the terms we have many of them, and some of them they call them Greeks. So let's just go through and demystify a few of the important terms. The most important one is time. Okay, how long am I going to take this contract for? And I'm going to switch to another ticker. I've used Affirm lately, and I like it because of how many contracts how many legs it has. Okay, so Affirm, I chose March. It has 46 days. So we've already established the term of this contract has 46 days on the clock. So time, we nailed it. We want 46. I could have chosen February, which has 18 days. Same thing, just the contract. Everything here has 46 days, time ticking. That's one. The second term is levels. I can set my price. Whether I do puts, which is this side, all these are puts, all these are calls. Don't worry about what they mean. So we have puts, one flavor of contracts, calls, one flavor of contracts. They all have 46 days, and they all can have different price levels. I choose, me. Okay, so that's the second term of the contract, time and levels, price. Okay, so what's another term? So all of these, everything on this page deals with Affirm, shares of Affirm. The contracts are to control shares of Affirm one way or another, puts or calls. So every contract you see here every contract represents 100 shares. So everything on this piece of paper, you multiply by 100. So for example, this one here says 2.5. That's $250 because it represents 100 shares. One contract, 100 shares. So it's 2.5, so that's 255. Simple as that. Okay. So now we've nailed down three variables, terms of this contract: time, price, and quantity. Quantity is 100 shares. All right. So now the next step is odds. Excuse me. So this column here is called the delta. I promise you I will speak as little Greek as possible. Now, the delta has an official definition, and it's somewhat wordy. So it says basically it's the amount of change in the contract that happens from a change in the underlying. Pretty wonky way of saying, you know what? That's really the odds maker. So let's put that to a test. Currently, the price is 64. So it's right here. So anything, that delta here, the delta is almost 0.5, 0.45, 0.5. So does that remind you of anything? What's 0.5? It's 50%. It's a coin flip. If I go to the call side, same thing. It's 0.5. So the price, the delta at current price or thereabouts is plus or minus 50 cents, 0.5. So it's a coin flip. So everything around current price has no edge. No one has an edge. The buyer and the seller are at equal footing. So if I have an opponent, I'm fighting at their level and I don't have an advantage. Why should I buy a put? The seller of the put has equal footing with the buyer of the put. Same with the call. The buyer of the call is at equal footing with the seller of the call. 0.5, 0.5. Okay. The further down I go from here, the delta drops on the put side. Look at it. It just drops to almost zero. The further up I go here, the delta drops. Excuse me. So let me put the words how this is the odds maker. So a low delta of 0.02 or 0.03 is saying there's almost no chance, it's almost zero. There's almost no chance that this stock right here, a firm, is at 30 or 25 in 46 days. That's what this is saying. There's almost no chance a firm is at 25 in 46 days. That's literally what a low delta says. And the delta of 0.4 or 0.5 is saying there's a 50-50 shot it'll be at 64 in 46 days because it's right now at 64. So the further lower I go, the less likely this scenario is going to happen. Okay, so that's why this is the odds maker. So this one has about a 10% chance. This one has about a 15% chance. It's not quite that, but I've been using it like that for years and it works wonders. So that's a quick way of gauging what are your odds. If you're buying, like if I'm buying this put, I have very little chance for it to come into money. So if I'm buying it to short a stock outright, I need a miracle for it to crash into that level for me to make money on that put. So that's what that says. Conversely, if I'm buying a call that has a 0.09 delta, this is saying there is very little chance, 0.09%, let's roughly 9%, 10%, very little chance a firm will be 110 in 46 days. Very little chance. So if I spend $100 buying this thing here, or $91, okay, it could happen, but a firm needs a miracle spike for it to get to me. But that would make one hell of a lottery ticket, right? So lottery ticket, low odds, low cost, low odds, lottery ticket. People should spend a little bit more money so they can get a more materialistic advantage. So up here, I only need a rally. I don't need a big rally. If a rally comes, I'm going to participate. Up here, I need a miracle rally. But I will make much more than here, dollar for dollar. But I may be wasting $100 per contract. So very low odds, 50-50 odds, very low odds, 50-50 odds. So that's the odds maker, the delta column. So if you train yourself to think that way, so okay, I can spend $300 and hope for a rally, or I can spend a little bit more and not need as big a rally to be in the money. That's the type of thing. So somewhere in the middle lies a good balance. And my balance is I need a 0.35-ish. So somewhere in between these two, I'm good to go with that. With 46 days on the clock, that seems to be a reasonable spot where I'm not paying a $900 per contract. I'm not paying $100 per contract. I'm paying well enough with decent odds that I will participate even with a mild rally. So on the put side, same thing. I don't want to buy this. I don't want to buy that. Somewhere in the middle lies the truth. Unfortunately, I don't have 57.5. That's what I would like. But between these two, I would probably buy the 55 if I were to short the stock, which none of this stuff is trade recommendations. I'm just merely displaying the numbers that I would need. Okay, so let's back into the definition of a put and a call. All right, so I'm going to assume that everybody's fresh. They don't know anything about anything. So this way, I'll provide the basics and everybody will be at equal footing. Sometimes I like to skip a few steps, but I think it's good to go back to basics. Okay, so far I have not told you what a put is or what a call is. So let's define the put from the protection perspective. If I owned 100 shares of a firm and I'm worried about them because I'm going on vacation and I cannot check the market for the next few weeks, I can buy insurance. In this case, I can spend $385 to buy one contract. Why would I buy only one? Because I own 100 shares. If I own 200, I would need two contracts. No, first of all, the rule is I don't need to own shares to buy puts, but I'm using this as an example. I own shares and I want to protect myself. I buy this contract. So I'll spend $385, and for the next 46 days, I can sleep knowing that I'm protected at 50. So if we wake up one day and there's World War III and a firm is at $35, I'm out at 50 if I want to. I'm in control. I hold the right, but not the obligation. I am not forced to file a claim. Just like when you buy insurance on your car and you don't have to file a claim for a scratch in the door or a fender bender, or if you back into a pole, you don't have to file a claim. You have the right to file a claim, but you don't have to. Then, your insurance company cannot call you and say, hey, I heard you had an accident. Where's my claim? They can't do that. Whoever sold you that put, they're at your mercy. The seller of the put just sits and waits. Maybe they get called upon. What do they have to do? They have to buy your shares at 50. So at any point in time, you get nervous about your shares, you can sell them at $50, regardless of price. It could be at 51, it could be at 35. Price does not have to be lower, although you'd be an idiot to do it if it was still higher, but it is doable. I guess the world is full of idiots somewhere. I've never seen it happen. Let's put it that way. So the seller of the put, unlike you, the buyer who's in control, the seller of the put is at your mercy. So one day the stock falls to 45, you wake up and you call your broker and say, you know what? I own that $50 put. Can you please get rid of my shares for 50? Thank you. I know the price is 45. So what happens is, boom, the person that sold you that put wakes up owning shares. That position that you had bought and they had sold disappears off the board, gone, because the transaction of you giving them your shares will take that off. They keep the money. They keep that $385. So their break-even point, I'm going to round it to 4. Their break-even point is $4 below that. So 46, they're still okay because you assigned them at 50, but you paid them $4 for it. So they can take a $4 loss and still break even after assignment. So it's not a bad deal for them. It's not a bearish thing. If you were bearish the stock, you would get rid of it. You wouldn't pay money to protect it, correct? So it's not bearish. Puts are not bearish. What you do with them is bearish. The seller of the put is not bearish. They actually want to buy your shares. That's why they sold the put. Never sell a put that you don't intend to own or you can't own, at least for 5 minutes. I never sell a put in a stock I think is junk because I don't want to own it, not even for a second. So I wouldn't sell a put. So buyer and seller of the put in this example are both somewhat bullish stock. So it's not a bearish thing to have a put. Okay, so when is a put bearish? So I just told you that I don't need to own shares to buy a put. That is the only way buying a put is bearish. Let's say I think that this company sucks. I don't, but let's say I do, and I think it's going to crash. If that's the case, then I would buy a put. I don't know what I say, and my watch thinks I'm talking to it. There's some words that it thinks that it's anyway. It's weird. So
Siri's always listening to you, Nick.
It's not Siri. I don't have an Apple Watch. It's a Samsung watch, and their guy's name or person's name is Bixby. And what did I just say that sounds like Bixby or something like that? I don't know what it is. It does it almost on every presentation. I must use a magical word that it wakes up. And now it thinks I'm working out because I'm using my hands. That's hilarious. Okay, back. So if I wanted to short the stock, I don't own shares. I go out and buy a put. And let me walk you through how I can make money on that. So that's a responsible way of shorting a stock. And I will use an example on which company I would use that now. So If I'm right about the stock needing to fall in the next month, then I would buy a put and wait. If price indeed falls, the put I buy will become more expensive. So all I have to do is just sell the put after the fact. So I pay $400 to be long this put. And if I'm right and price falls, that 400 turns into 700 or 1,000, depends on how deep it falls. If that's the case, boom, I made money. I'll give you a specific example how I shared it with the team to make money off of the XLF. So the XLF is the ETF for banks, right? And banks are the ones that started reporting earliest. I think JP Morgan on a Friday, 12, 13, 14, boom, 18. So, or Thursday. So the day before they reported was right here. They said, how are you playing banks' earnings? I said, I do not like banks going into a Fed tightening process. They're going to lose a lot of advantages that the Fed was throwing money at them to spruce up the economy. And now the economy is too hot. All these advantages are going to disappear. I said, if it was me, I would sell a call spread. We haven't talked about it. That's just a bearish position where I collect money for. And then I would buy a put, a $40 put at the time, or a $41 put. So if somebody did that, they made money from here down to here. So they bought a put, they paid whatever it was, 30 cents, 20 cents, and it turned into dollars because price fell well below the $40 put I thought they needed to buy, or the 41, I can't remember. So if somebody did that, they bought a put, they don't own shares. So they needed the stock to fall fast, and it did. So if they paid 30 cents, I'm going to round, then it turned into $2. So suddenly they made $2 minus 30 cents per contract. So every contract they bought made them hundreds of dollars. That's a mild way, easy way of shorting a stock where your maximum loss was the money you spent up front. And in this case, they didn't spend any money because I suggested selling a call spread, which brings in money, credits, and then spending those credits to buy a put. So you're short for free. That was a very profitable trade. I didn't do it. You'd think I'd take my own advice, but that was the trade before the earnings. So now I wouldn't short them. They fell already. What do I short now?
That actually is a great answer to one of our chats here from Toronto the Great is the username, where he asks, can you anticipate a put before it reverses? Resistance is at, he's giving an example of resistance at $100 for the stock, trading at $95, very bearish chart, so on and so forth with VWAP, moving averages, etc. So in this case, you said you had a thesis basically on the banks. You saw it had a run up, and then you estimated that it was due for a fall.
Yes, because I thought they had a gravy train that was going to end. So I'll give you another example. Last year, I shorted EWG, which is the DAX, basically Germany's market. And my thesis back then, this is a quarterly chart, so long term, like to the 90s. So it's a slow moving chart. And my thesis was simple. It was this. We had the dot-com bubble, the 2008 debacle, and we were making new highs. I said, I'm going to short it because it failed the last time, 2 times it went there. And I shorted it, and it was rough for a few days, but it played out. But same thing. I mean, it played out nicely. Guess what I would do it with now? That's Chevron. Why is Chevron at all-time highs? When we're, as a world, we're saying we're going to kill the use of fossil fuels. Did it buy a solar company? So my thesis is I think Chevron should fall. So if not Chevron, Exxon, but Exxon is not at its all-time highs. That's another reason. Why is Chevron at its all-time high? They're like identical companies almost. Or you can short the XLE, which is 44% of it is Chevron and Exxon. 2 companies are 44% of it. I wouldn't touch the USO or anything like that because those are manipulated markets and you don't want to fight idiots. So Chevron, it's easy. Whoops, CVX would qualify for me. Like I said last week, I would have sold call spreads and bought puts, like what I suggested to do with the XLF. So This is going against the grain. Every expert out there tells you it's a super spike in oil, and because supply and demand, and I just don't get it. Supply and demand. We're driving more EVs. We have more solar power. Every country has penalties for companies that don't have a smaller carbon footprint. So ESG investing, if it's not schmutz, if it's not crap, then we are going to use less fossil fuel. And we're commuting less, we're zooming more, we're telecommuting for work more. So where is that increased demand? The only reason is that we stopped drilling some things. So we don't have a supply problem. We have a political problem that doesn't want to drill for oil or pump oil or whatever. So anyway, my long story is you're fighting the tape if you take this idea of shorting, fading Chevron. But they report earnings soon, do they not? Or is that Exxon? Exxon, they reported already. So Exxon reports today or tomorrow. Double check that. Yeah, 2-1. So maybe tomorrow before the open. I'd be interested to see if it drops like Chevron. So anyway, yes, buying a put is a bearish trade that has finite consequences. So unlike selling a stock short outright traditionally, which leaves me at risk until I cover my short here, my maximum loss is $385 in this case. So I can swallow that. I can take that risk and say, you know what, in 2 days, if I change my mind, maybe I lose $100 per contract because I can change my mind and salvage whatever value is left. Okay, so that is a put position / trade that is bearish. And that's the only scenario that where the put is bearish is when I buy puts and I do not own shares. My intentions are I need a stock drop in order for me to make money. That's the only reason why I would buy a put, is to short it if I don't own shares. Okay, let's hop onto the call side. So who would buy a call and what does it do? The call is also a contract that affords the buyer the right but not the obligation. So let's say I wanted to buy 100 shares of a firm. Today would have cost me $6,400. Let's say I'm a little bit nervous about this week because of the jobs number on Friday, blah, blah, blah. And I wish I could take the trade, but with a little bit less out-of-pocket expense. I don't want to put $6,400 in the line of fire right away. How can I do that for less? Well, I can do that for $1,900 to be exact. How do I do that? Instead of buying 100 shares, I buy one call. So what does that do? I buy one call that has 46 days on the clock. I can choose any which one I want. In this case, we're on this one. We'll go March. This has 46 days, so it's March 18th is when it expires. It cost me $910 to buy. And then what happens is I lock my price at 65. So if the stock rallies to $1 million, I'm in at 65. Some poor schlep out there who sold me the call needs to deliver shares at that price. It happened to me today. That's when I said I left money on the table. I was long something. I sold a call, covered call against it. I locked my profit and limited my upside potential, thinking the day was done and earlier than it was. So in this case, hopefully they own shares, because if they don't own shares, then that means they're on the hook and in potentially paying for a lot of levels above it. So me, the buyer, would lock my purchase price at 65. The seller of the call is on the hook to deliver me 100 shares at 65. What if a firm gets a buyout and it goes to 110? They immediately lost $50 or $55 per share. So because they have to deliver me at 65. So they have to go out there and buy 100 shares. The going rate is now 110. What do? They're stuck. They lost $55 per share. So that's why do not ever sell a call naked. What does that naked mean? Where you don't own shares. So if somebody owned 100 shares of a firm, they can sell this call and not be at risk, because all they have to do is just give you their shares. They own them at whatever price and they sell them at 65 and they keep the $9. So they keep the $900. So they stop participating at 75. So it's like they ride it all the way to here and then they're gone. They don't participate to the upside. This is called a covered call. When you sell it and you own shares, or you sell it and you own calls against it longer term. Outstanding way of putting your asset to work, but not at the level where the money is. Usually you go higher and you try to create income out of, for example, if I owned 100 shares of a firm, I can sell the $90 call, collect $250 right now. And all I have to do is promise I would sell you my shares up here. Hell yeah, all day. So the worst case scenario, I get the profit from here to here, and then must give you my shares maybe, and then keep my $250. Done. Some people are crippled. They can't do it. They get paralyzed by, oh my God, what if I lose my share? So what? You lose your shares. You buy some more. Where's the big deal? Not a big deal in my book. So a good covered call strategy is good, but you have to own shares. Otherwise, don't do it. So calls, the buyer of the calls owns the right to buy shares at that price. The seller of the call has the obligation to deliver them those shares wherever they got them. If they own it, great. If they don't own it, they're stuck and they got to go out, buy it in the open market. Okay, so is this bearish or bullish? The buyer of the call is bullish. They can only profit if price rises. The seller of the call may be bullish if they own shares, but if they don't own shares, it's definitely bearish. That's like buying a put when you don't own shares. Selling a call naked or buying a put when you don't own shares are both two bearish scenarios. Okay, you need price to not rally in past the call you sell if you don't own shares. Don't ever do it. Okay, so the call controls the purchase price of an equity. The buyer has that control. The seller is at the mercy of the buyer. So if I wanted to participate from a rally in a firm, I can buy the call without ever intending to buy the shares. So how does that work out? I pay 900, and let's say I was right and the stock rallied. That 900 explodes in value. Look how much more expensive they are at lower prices, where price has gone through already. That's called in the money. The call goes in the money. It explodes in value. And all I have to do is just sell it. So I don't even need to buy the shares. Boom. I sell it, made money. So, and it's a leveraged effect. For example, today a firm rallied 7%. Sweet. So if you bought shares yesterday, Friday, you made 7%. Well, if you bought calls, you made 20%. And if you bought calls in February, you made a little bit more. Let me see how much these guys are. Okay, so this is a little whacked out. It should be more. That's more like it. So if you bought next week's calls, you made 30% on the rally. Much more leverage than the 7%. But it cuts both ways. If you bought puts, you lost just as much. So you better be surgical and on purpose with your entries. Oh, I know why. Okay, hold on. Let me go back to 65. Now it makes sense. See? Okay, so this week's contracts gains the fastest, 30, 40%, versus the other one, 17, 18%. But it also loses the fastest. So you can't just buy calls and puts willy-nilly. You have to be good with the levels. You have to be diligent, which brings me to a little sticky note you have to have next to your desk. Put the acronym NTNT, no trigger, no trade. And the T could be thesis, no trade. So if you don't do charts, you can still use that mantra. In other words, don't ever take a trade on a whim. You need to have a reason. And by the way, I thought it was going to go up. Is not a reason. That's just a guess. I thought it was going to go up because X, Y, and Z. Okay, maybe. But don't take trades willy-nilly. You have to be with purpose. Then, because you have to be true to yourself, because you need to know when to get out. So if that reason that got you into the trade is gone, then you need to be out. Let's say you took the trade on an earnings. That's a crappy reason. But let's say you did that. And then the earnings are out and there was no movement in the stock like you thought, then you should be out. Then you know to be out. If you took the trade because you thought they were going to announce something and time passes and that something doesn't get announced, you should be. Why are you still in the trade? So if you have a reason to get in, then it's you're out. It's a reason to get out. All right. So somebody's saying, explain in the money. Jason, sounds like you need to be in the group. Join the group and get to the chat room pretty quickly. They're asking, what is an in the money? In the money means an option contract that has been engulfed by current price. For example, this is a $67 call. Current price is 64. Is that in the money or not? Current price is 64. The call side, $67. Is that in the money or not? I'm glad you asked, Nick. That is not in the money. Thank you, Linda. The awkward silence has been... Okay, it is not in the money. This one is in the money, barely, 7 cents. This one is in the money by $1. This one is in the money by $2, meaning current price is higher. That's all that means. It doesn't mean you won or lost. It's a term to say price has exceeded the level. That's on the call side. On the put side, these puts are not in the money. Price is falling towards them. These puts are in the money. How do you know? When they have a high delta, more than 0.5, they're in the money. When they have a high delta, more than 0.5, they're in the money. So if delta is 1, it behaves just like the stock, and you rarely see it. You see high 90s. So that's how you know it's in the money. Okay, another question. If a person does not have an account large enough to buy 100 shares, like a firm, I would not sell a naked put. I could sell a put spread, which is a good segue. A put spread. So we just defined a put. We just defined a call. They're both options. I use the term naked. Naked means one leg, just one. I bought a put. I bought one leg. I bought a naked put. So what's another term I just used? Let me see here. I need to make the window bigger without shrinking the font on you. Okay, there we go. If I do 2 of them, that's a spread. If I buy one and sell one, that's a spread. Okay, so earlier I used the example of, let's go back to March to see a visual. I used this example, the 50 and the 45. Okay, so let's say I want to buy shares. Okay, but I want to buy them at a little bit lower. So what do? I go out and I sell a put. I say, I don't, buying shares involves me spending $6,400 today. What's wrong with collecting almost $300 for the promise of buying them at 45? So my worst case scenario here is that maybe if the stock market crashes in the next 46 days and this stock falls to or below 45, I may wake up owning shares at 45 and I get paid for it. Meaning I don't start losing until I get assigned shares at 45. And then I have $2.50 below that. So I won't start losing until 42.50 or lower. Hell yeah, that's feasible for me. But the question is, what if I don't have a big enough account to where I can commit to buying $4,500 worth of shares? So then I would use a put spread. So the put spread, I add another thing I do that limits how much I'm collecting. So now if I do a spread, I sell the one I wanted to sell, but I buy something below it. See, this one gets me on the hook to buy it. This one gets me off the hook to sell it. So the worst case scenario is $5 per contract. So now I limited the maximum risk. So the platform is happy. Hey, if this stock goes to zero, this guy is only going to lose $5 per contract. So that's $500. But he's also collecting $100. So his maximum loss is $400. So the account can be $2,000 and you can still trade these strategies. I would not put one trade to count 20-30% of my account, but you don't need a massive account to trade credit put spreads or credit call spreads. So put spread, it's called the credit because I'm selling the higher one, buying the lower one. Therefore, the end result is a credit. So for me to open this trade, I collect money and I wait. If price stays above 45 for 46, in 46 days, if price is above 45, this dies for zero. This goes to zero. It's now worth 90 cents, $90. It goes to zero. So if I sold it, it goes to zero. The buyer bought a losing lottery ticket from me. That's what it means. And if I sell everything at a low delta, the statistics tell me I'm going to be more right than wrong. This one is the best statistically viable one. This one has a 90% chance of success, thereabouts. 89 to 92%, depends on the VIX. Okay, so now I'm only collecting 66 cents, so 70 bucks-ish, $70. But I have the odds in my favor. It's going to take a miracle for this to get busted. Again, this is not a trade alert because there's an earnings report coming up, and I don't do these into earnings reports. You're saying, why, Nick? Just look at Netflix. Not one of these trades survived during Netflix, hedged or not, iron condor or not one survived, because the earnings reaction is a complete coin flip that you cannot forecast. Okay, you say you can, I'm guaranteeing you cannot. Proof? Once and for all? You want proof once and for all? Okay, Tesla reported an incredible record quarter. They beat every expectations. They guided okay. They didn't guide crappy, and the stock fell 11%. Now, contrast that. Robinhood, reported the crappiest report ever. They forecasted lower than expectations, terrible quarter going forward. The stock rallies 2 days in a row, worth 20%. I think. I forgot where it was today, but it rallied 10% the first day, and today, whatever it rallied. So quality of the report does not dictate how the price moves the next day. It's a complete crapshoot. If you think you know, you're wrong. Guaranteed, mathematically proven fact. Okay, so don't gamble your money on an earnings report without calling it a gamble. It's okay to make a bet if you're a good guesser, but if you're risking 10 grand on it, you're a gambler. That's my opinion, and I'm sticking to it. I can back it up with facts. So you do not have an advantage if you're taking a bet on the reaction for the earnings. Therefore, I don't take this trade into earnings. And if I do, I don't defend it. I will take the share assignment because I believe in the company, and I wouldn't mind holding it at 45 and break even lower. Okay.
There are 3 questions here in the chat, Nick, and you can skip these if you're on a roll. Just really quick. The first one is from Grant: how to deal with time decay when buying options. The Thinker: can you sell your contracts at any time? Yellow Sailfish: S debit iron condor. And yeah, those are the top 3.
Okay. Can you sell your option at any point in time? Yes. If you bought something, you can sell it at any point in time before it expires. Absolutely. How do you make your odds better when you're buying? You sell stuff. Just kidding. So when you buy an option, if you're buying a call or buying a put, make sure you buy something worth buying. Don't buy low delta. Low delta, by definition, has low odds of success. So you might want to increase your odds of success a little bit better. For example, let's say you want to bet upside on a firm. You would buy a call. So which one do I buy? So if I buy this one, it's the most expensive. But as soon as it moves up, I'm in the money right away, and I don't need a big rally. I just need it to rally. It's like buying shares. That's viable, high delta. I can buy one of these 3 and still be okay. This one is also okay. 0.32, 0.33 delta is also still okay. Anything below that becomes of a long shot. So let's say it doesn't move for a week. 10 days go off of this 46. That's a big chunk of 46, 10 days. That's a big, what's that, 18%? That's a big chunk of time gone out of the whole contract. So these will fizzle faster, and they will they become less relevant. So this 0.26 will turn into 0.15. So if I buy a call and the delta falls to like 0.15, I would close it because it's now a hopium rally. So if it still had money in it, like let's say it's still worth $200, I would save that $200. And if I wanted to stay long, I would respend the $200 closer here somehow. I wouldn't increase the number. I would just change, give it better odds. So low delta is no good to buy. Now, it makes for a good lottery ticket. Case in point today, late in the day, somebody said, what's a good trade going into the close with 20 minutes to go? I said, well, there's something that's about 30 cents that could explode in value, and it had a very low delta. I said that would be the one, but it was a lottery ticket. So they spent 30 cents. Hopefully they did 10. So that's $300. And it immediately went up like 280% because the market exploded into the close. So hopefully they bought 10. I know they did at least 1 or 2 or 3. So let's hope they did 10. Then that means they turned $300 over 280%. That's a pretty nice win late in the day, right? So sometimes those lottery tickets play out. But as a habit, I don't mess with the low delta. I make sure like it's between these two. 0.33 to 0.4. Oh shit. Excuse me. I hear banging in my garage. I'm just making sure my son he's cutting up a trophy truck for a friend. Okay, no, that's good. He started it. Okay. All right. So good questions. What was the last one?
The last one.
Oh, iron condors.
Yeah. Okay. He was asking debit. He or she was asking debit iron condor.
So the debit, there's no debit iron condor. The iron condor is a credit, and it's a beautiful trade. I'll give you a visual of it. And again, this is not a trade recommendation because of the earnings. Okay. So we just talked about credit put spread. By the way, you've also heard this called bull put spread. They call it a bull trade, but you don't need a rally. All you need is no collapse. So it is bullish in the sense but it does not need a rally. Like if I buy a call, I need a rally. If I buy shares, I need a rally. This one delivers 13-14% yield on the risk with no rally. In fact, you can fall. So that's one thing. And the opposite thing is doing the same thing on this side. I'm going to do air mount here. That's pretty good. All right. So this is a bullish position. This is a bearish position. This is called a bear call spread. Credit call spread. Call on this side. Spread, same as this one. Credit because I'm collecting a credit. The difference between these two is in my favor. I sell the higher cost one and buy the lower cost one. So I'm short at 95, I'm long at 40. That's what this says. That right there, folks, is an iron condor. So in total, I collect $100. In total, I can only lose $400. So this trade needs absolutely nothing to happen, and it delivers 25% yield on my risk. Compare that with buying shares. So to mimic the results I get from this, I need to spend $400 to buy shares and need a 25% rally, or short a stock for $400 and need a 25% drop to win. In this case, I need absolutely nothing. The stock can collapse to 40, the stock can skyrocket to 95, and I can still win 25% on my risk. I collect $100 right now, and the maximum I can lose is $400. Those are the snoozer trades I usually like. However, this has an earnings report. Therefore, I would not do this into an earnings report. Capiche? If you did this for Netflix, you got blown out to maximum loss, 1,000%. Not one of these survived through the Netflix earnings report. Now, that's rare, but they do happen. And why? I can do the same trade after the earnings without the headline of the earnings. So this is a viable trade setup. Iron Condor. Okay. This was not a trade alert. I would not do it through the earnings. I can do it here. If the earnings come after this one, I can do it here. So I did not pay attention what the date was on the earnings. 210. So no, I wouldn't do it. So either this week or nothing. So there's no real time to do an Iron Condor with that one. But if you join the group, I share 8 Iron Condors a week at the table, 8 to 10, depends on the week. I also share all the trade setups in the chat room. So what are we offering here today?
Yeah, today is the last day. Some people are asking about what's included earlier. Today is the last day for half off of all options mentorship plans. So you could go monthly. That would be $173.50 a month. Normally that's $347 a month. Or you could go annual, and that'd be $1683 for the whole year instead of the over $3,300 for the year. So I'm throwing the links in the chat, and I'll show you a little bit more about what's included in that. But I mean,
are we offering an entry into the chat room by any chance anywhere?
Yes, that's included with that.
Oh, yeah. Okay. That's pretty important, folks, because let me tell you what happens in there. I'm going to show you my screen, okay? So this screen is up and running all day live. This and that. This is a table that I did yesterday live with 100 people in the room, 80 people, I can't remember. These are 133 tickers that you asked for. So I go in and I give you links to them so you can refer to it any point in time with my notes. So all these notes, I do this on my own on Saturday night for Sunday review. I do a video and I share it. I do a strategy video and I share it. Every morning I come in here, I share my strategy for the day with all the lines for that day, for the indices in the ETFs. And I share trade setups almost daily. Today I shared 2 with video. I think it was 15-minute video. And you have access to me to trade these things intraday. Like, for example, this was today's trade setup in the morning, right there. So this was today's morning, right? That was the open. We got to here. I said, overnight high catalyst. So if somebody wants to chase it, they did. I said, this is where Fed heads were talking, just to look out for Fed heads talking. And then I said, this is a clean breakout line. If somebody wants to chase it, and this is the upside potential, right? Right from here. So if they took that, they got to here, and they had the opportunity to take it twice because I said it repeats right here. That was another rally. So if they took this one and did nothing, they got maximum. And look where it died the first time. I should have done something with that one. I would have made my day twice as profitable as it was, but I didn't. So I made a mistake. But anyway, then there was another rally here. And then the last burst, I did not put a line because I was speaking. So this stuff is available to you if you want to. You hop in, you say, Nick, I'm looking to trade something. What do you think? Today, I answered at least 3 or 4 questions specific to selling covered calls. I own a call. I want to book some profits. How can I do it? Somebody bought a call, and I always say lock some profits. He goes, you say lock profits. What does that mean? I walked them through an example. So basically, they collected 90 cents in credits, so $100 almost per contract, to be long a debit call spread that is now worth over $1. And they can hold it knowing that there's no way they can lose that $100 they just made per contract, and they can make another 200 on top of it. All they need is time to tick because that debit call spread is already in the money. So all this stuff happens live. So if you're serious about trading and leveling up your trades, join us, because you can't put a dollar sign next to a venue where you can just pop in and talk to me or anybody. 260 people are in the room on a daily basis, 230 to 260. Different kinds of traders, There aren't any jerks in there, and everybody's honest. There are no judgments. People pitching tickers all the time. What do we track? These two are S&P. That's the NASDAQ. That's the small caps, both of these. That's fear. That's Tesla. We've got Nvidia, Amazon, Apple, Facebook, Netflix. Netflix today trade setup was right from the get-go. I said, don't short Netflix. It's going to surprise people today. And I said, it's going inside of this, and the sellers are going to get stuck shorting it. And it went sideways. And I said, these lines are just too easy. Do not short it. And somebody went long. Boop. So they just ran out of time. They were going because now they're in open air. The bears have nothing. They have to go way back to these candles. And those are weird candles. So, I shared along via video as well. And that worked out after a little bit of hiccups. Lucid is covered. What else? Microsoft, Shopify. Look at Shopify. I tracked this all day for them, and I said, if it breaks out of the box, you've got a big, the time ran out. They would have done very well. TTD is over here. Roku, little breakout. Affirm, the company we're talking about. Bitcoin, all of these. We have Pinterest. Here's the Bitcoin trade. It's unfolding exactly how I said it would, and I'm in it. So they're selling pops systemically. They need to recover 39.6. If they don't, they need to hold this. If they don't, they're coming down to here in this sell the pop mode. So will they sell the pop? That's question number one. And if they do, will they do it again somewhere down here? So we're all about purpose. And I'm very clear with my charts. Plain simple English. I don't have tools. Look, there are no tools on this chart. Nothing. Everything you see is hand drawn because I use levels and plain simple English to explain everything. If this is something you like, join. This is Bitcoin from a different perspective. CRO, ADA, SOL, which is one of my favorite coins. Ethereum, my least favorite coin because I have to pay every time I do something. In Ethereum, in Ether, and Doge, fun coin to have. Okay.
And so this, just to reiterate, this is what it looks like. You're on here probably 8 to 9 hours a day, right, Nick? So this is your live trading room.
Yep.
But not everyone in here is going to be able to sit here and trade all day. So to all you beginners or part-timers out there, I want to emphasize that you don't have to sit in front of your computer all day. I'm going to go ahead and share my screen really quick. What was that?
You can just pop in and say, I've got a problem trade. How do I handle that? Today, somebody said, I got caught too short. What do I do, Nick? So
exactly. So Nick is always there in case you get into trouble, or if you just have a question about one of your own trades. Hopefully you're doing your own research and finding your own trades, and then you can ask Nick about those as well.
I would love to join you. Like somebody brought me a trade this weekend. It's called Zim. So I'm not a guy that chases all-time high breakouts like that. But then you look at the P&L of this company and it's like, my God, they must have discovered the fountain of youth or something in the pandemic because it's exploding. It's an Israeli company and it's just doing super well. So maybe it goes to 100 like they said they would. Somebody else will pop in and say, what about DQ? Like, I've never heard of DQ. What the hell is that? So I look at the P&L. The P&L is solid, bulletproof, and the chart cannot find footing. So maybe it's a gem. Maybe it's a golden opportunity to get long when everybody else hates it at an all-time low. I mean, this is not Wish. So, so it's the conversation is both ways. We're in there. Yes, I'm in here at 4:20 my time, a.m. in California time. But I don't really start talking until like 6 a.m. So just about half hour before the market opens because it's just a lot of talking all day.
Right.
And then I'm on and off. I mean, the window is open for everybody. And somebody would say, you know what? I'm trading Netflix. Can you please give me guidelines? I do. And I leave it on the screen for a little bit. And then I pop back over to monitoring the markets. And the debate is ongoing all day. So I usually have a message like here. on
Oh,
pops.
sorry. I'm actually sharing my screen so they can't see your screen
Oh,
right
okay.
now.
Yeah. No worries. No worries. No worries.
Um,
So I have a reminder on my screen saying what I should do on pops. I should fix trades that were broken. So I'll take the screen back if you don't mind,
yeah, I
because
stopped
that's
sharing.
an important statement right now. So, what are you doing on this pop? You should be fixing trades that were broken. Like if you had a trade that was severely under fire last week, and suddenly now you got woo, yay, it's all fine and dandy, and you leave it on. Hmm, that's no. I take it as a gift. Thank you. I'm out. Like somebody was stuck in an Amazon credit put spread the wrong way. This pop put them in good shape. They took advantage of it. Excuse me. If I had bought some calls or call spreads in Netflix and they got shellacked and now they're back to life, guess what? Time to fix it. Or if I bought some calls last week, like I did, time to book some profits. I did today. I did a little bit too early, unfortunately. I missed out on this one and capped my rally, my profit. So tomorrow morning, I need a strong open, and then I would fix that mistake I did today. Or it's also time to buy insurance if I think I still need it. So in November, I shared a 20-minute video saying how I buy insurance. The VIX was at 17, actually under, it was like 15. So imagine if somebody listened to me and bought calls in the VIX. It went to 30 something, right? So that is nice fat payday to offset some losses that were pretty severe. So the guidance is pretty much well rounded. I'm not like one sided, always up and away. So I encourage you, if you have it in the budget and if you really want to be a good trader, investor, even if you're not active. I mean, everybody has a job that is in the chat room, I'm going to assume, but they find time to pop in and out. Some of them hang out all day, so they might be off hours. International, we have people that go to sleep when we're waking up, and they wake up to trade. So it is. I think I'd be shocked if you'd be disappointed at the value of what you're paying for. I don't know how much it costs, but I would be shocked. Plus Benzinga gives you a money back guarantee. You have a certain number of days to say, you know what, that wasn't what I signed up for. I don't care. It doesn't work for me. I don't like Nick. I don't like the people with Nick. Then you just get out. No harm done.
That's true. We've got a 7-day money back guarantee on all of our subscriptions. So with today's 50% discount, that's $173 a month or $16.83 per year. So you'll save a few $100 if you do that. I'm going to share my screen again
Go
here,
ahead.
Nick. Just to reiterate what's included. So you've got live trading with Nick from 9 a.m. Eastern to 4 p.m. Eastern or later every trading day. He posts daily swing trade picks with like a 10 to 15 minute analysis video in the chat every day. So if you are a beginner, you don't even have to know everything yet to understand with clear logical frameworks
Correct.
how you could make money while protecting your capital. This isn't a crystal ball. It's logical, it's mathematical, because if you just look at historical analysis, if you look at what the charts have done in the past, it just makes sense. So you're not going to win it all the time, but like we were talking about earlier with watching the deltas, what is the theoretical probability of success in this situation, and stack the cards in your favor. Then you have weekend charting sessions with over 100 companies that Nick covers every Sunday morning. He's busting his butt on the weekends for all of you so that you can learn from him how to think about these companies. It doesn't come overnight, but if you just absorb that analysis every weekend, and he provides a table like a Google Doc or an Excel spreadsheet where you can take notes or see his notes on all of the companies that are covered. And then lastly, that includes all Benzinga Pro tools. I'm going to close out of this screen presentation here so that you can see Benzinga Pro. We're not covering all of what's included in Benzinga Pro today, but with Benzinga Pro, you've got the options inner circle chat here where Nick shares his analysis on Nike and eBay. He's sharing his links to his live trading session. So this is really your home base where everything happens. And then you can click into all the charts, and as well as all these other tools like the advanced news feed, like our scanner, so that you can find stocks that are taking off. You've got calendars at your disposal, so you can look up earnings, analyst ratings, FDA approvals, unusual options activity. All of this is included with the options mentorship plan. So you've got the chat, you've got the live trading, you've got a daily trade pick with analysis every single day. And if you don't have time to sit in front of your computer all day, you can do your homework on the weekends and trade off of those support and resistance levels that Nick gives you. So today is the last day for the half off. That does end at midnight tonight. So use that code NEW22. I threw it in the chat. What was that, Nick?
Da, da, da. Da.
And I'm speaking fast because I am excited. This is an amazing opportunity to actually learn how to manage your risk. Like we were talking about, even if you have a small account, you don't have to have a huge account. You don't have to be able to buy 100 shares and sell cash covered puts. You can use these spread setups to manage your risk and build your account over time.
Yep, definitely. Spreads is where if somebody's new to options, they should really get their feet wet with spreads. First, practice with paper money. Luckily, that's easily doable. Then use spreads, excuse me, to just limit the risk on the upside and the downside. Once you get comfortable with it, in my opinion, every investor should know how to use options. Like I cannot convince my brother to use options. He owns shares. He does well with his job. He's a surgeon, but he cannot get himself to sell covered calls. Like I would beg him, please. I mean, this is just money just dying on the vine, but it's not for everybody. So options do provide a whole bunch of ways you can protect your shares. Even if you don't want to make money using options, you can protect your shares temporarily for free if you own shares in stocks. I'm trying to convert people one at a time to actually start selling covered calls to put their assets to work. And I think Jason Raznick finally started putting his Tesla shares to work and making some money. And we're talking with Tesla, it's like thousands of dollars a week because the premiums are so high if you have that kind of money. So
I'm posting the link in the chat here. We've got a couple different chats going, and yeah, so you don't have to have a huge account. Someone's asking, how do you define small account? Well, it's all relative, right? Some of us are working with a couple grand.
So I can answer. I can answer that without insulting anyone. So for selling naked puts, so when like selling a put requires some a decent size account, more than 10,000, because of the platform requires the broker wants to know that you have the money to buy the shares you're selling put against. So if you're selling a $2 stock put, that's not a big deal. But if you're selling a $100 stock put, they want to know that you have 100 times the share cost,
right?
That you can bring in. So a small account for the purpose of selling puts is anything under 5,000, 10,000 is relatively small, because then you're restricted to very low dollar stocks. Versus with spreads, it doesn't matter, because the spread limits the maximum loss. So if the maximum loss is 400, it doesn't matter if you have $1 million account or $1,000 account, you can still take the trade. So
absolutely. And I am sharing Benzinga Pro right now. I think we've got maybe about 15 minutes left with Nick here. So Nick, if you want to take the screen back, should we have a little ticker time?
Sure. This will stop the other guys. Okay, let's go. Ticker tape trade.
So go ahead, throw in the chat here. Give us a couple tickers that you guys want to take a look at. I'm scrolling back in the chat here. Someone wanted to look at, I think it was INTC earlier. The thinker
Intel?
was saying
Yeah, Intel.
INTC.
All right, so this is a weekly chart on Intel. The easy statement, every time it falls into, let me see, every time it falls into this box area, it gets bought. So Intel is the cheapest semiconductor company, and it's the biggest. This one is bigger than AMD and Nvidia put together twice over. So it does not get the respect it deserves. Buying Intel in these levels is hardly a mistake. So that would be the call on Intel. AMD, one of them is going into earnings, are they not? Yeah, AMD, I think maybe tomorrow even. So my call on AMD was a bounce along this path, and it did about half. So if I'm not long AMD going into earnings, I'm less sure about the reaction from the earnings. Not because the earnings are not going to be great. I have no doubt in my mind that they're going to deliver another excellent report. But I can't trust these idiots out there, how they're going to trade it on that headline. If they can sell down a stock 11% like Tesla that actually grew sales 65%, they can do whatever they want. Logic need not apply. So don't expect a pop because the report is going to be strong. The report is always strong, and it's not always a pop on earnings. So it is a coin flip. This was
on
a
the
drop.
other chat here, we do have Nvidia as well.
Right. So if you force me to take a trade, I would say there is more upside potential after a potential hiccup in the earnings. So if it dips on earnings, I'll get long. If it loses this one, it's going to the 70s. So if it loses 99, 98, it is likely to go to the 70s, but that would be a market correction. It's not going to do it on its own. It's too good of a company. Management's too good. The financials are too good. For it to go down there all by itself I'd be shocked. But technically, it would go there, but it would not happen without a market correction. So if we go to war with Russia, maybe. But if we don't, I don't think it's going to do that. It'll dip here. I'll buy the dip, and I'll write it back up. So Nvidia, same exact comment. So this was my path for Nvidia. And I bet you when I drew it up here, people thought I was crazy. So I said, look, if it fails, the red path is the risk. And that was up here. So guess what? The red path played out to a T. And they lost footing, and they went straight down and overshot. They did overshoot. But look at where they found footing. Look left. Into my support zone. This was a support zone. Can try longs here. It didn't hold. Now they're back to it. So I anticipate sellers hiding in here. So the easy bounce has happened, and now it'll probably move in sympathy with the reaction to the AMD report. So maybe going long Nvidia now is better than AMD just because it does not have an earnings report. So it will move with AMD, but not to the same extent. So that's the case for Nvidia. Great company, unbelievable financials, leadership role, too expensive. AMD is half as cheap with just as good of fundamentals and growth rates. Intel, dirt cheap. So from a value perspective, Intel. Apple, I don't like up here. It will move with the company, with the stock market, but all by itself, I'm not too impressed with it. It bounced off of support. This was the downside scenario for me. It came within an inch of it. And I said, on the bounce, they could revert lower to second leg, but they, this bounce here kind of negates that possibility. So leg one was met. Perfect head and shoulders right here. And I did a video on that, by the way. I said we have warning one, warning two. Warning one, warning two. They both fired. And not only did they fire, in the same week, they filled all of it, which was the good news. They kind of like ripped the Band-Aid all at one time. And then boom, right back. So this is good leadership role from Apple. Thank God for that. Now, that would not be my choice to get long into these two things here. Not because it's going to fail, shorted or anything. It's just not an easy entry going into a prior fail. Not for me.
We've got a couple more here from the other chat. We've got MO and ATVI.
Okay, ammo. Yeah, people, come on. You can come up with two better tickers than here. So ATVI is an arbitrage trade, right? So they were offered, what was it, $95 a share? Why on earth is it not at $95 per share? The market thinks it's not going to happen. They probably think there's regulatory, the government is going to say, no, you can't do that, regulatory issues. This usually arbitrage is pennies. This is like what? $95, I think, was the buyout price. Why on earth, or was it 88? Let's say it's 90. Why is it at 90? If they have a guaranteed buyer at 90, that is way too whacked out. In fact, when it was up here, I said, maybe you buy a put and see what happens. I mean, why is it so far away from the buyout price? So I wouldn't touch it. Unless you know insider information, I wouldn't touch it. Mo, people still smoke, I guess. Technically, it's frisky. So you take that out, you're gone, like gone. But let's zoom out and see on a weekly basis. Man, yeah, I would not short that. But this has been a wall since 2019. How likely is it that that's the time they're going to bust out of it? You see that green thing here? Hold on for a second. Yeah, this is where I would want to see the breakout happen for me to chase it at the risk of missing the breakout. Just because of it's been failing since 2019. Why now? Why this is the time for it to bust out?
All right, and then we've got X, Netflix, Tesla, and BBY.
BBY, Netflix, and Tesla. So Netflix we already covered. It's a long off the low. How much of this is weird? So I shared a long. I would stay long. If you're looking to get long now, it's not too late, I guess. Depends on your time horizon. So I thought Netflix at the lows below 2018 levels was an absolutely stupid level to be at. This is 2018. You remember the crash into Christmas because the Fed raised rates, quote, on automatically, whatever, auto cruise control, whatever he said. Well, we fell below 2018 levels and 2019 levels and the pandemic levels. That was just silly. And it was a dumb buy. I said, no, it was a long for sure with conviction. Okay. Even if it wasn't the bottom, it was a long with conviction. Tesla and what else did you say?
X. I think that's
okay.
steel.
The letter X, US Steel. Okay. So Tesla, I'm going to show you this one because I have lines on it. So here's the story with Tesla. All right. So the bears have it. They're selling rips inside this descending channel, right? And this rally brings the fight back to the upper end of the channel. Now, this is not a line. This is a behavior. So the rallies are being sold. We have higher lows and lower highs coming to blows here. So they either go this way or they revert a little bit lower, and I would get long at or under 900. So if I'm not long yet, I'm going to wait out this candle and that candle. So somebody today said, excuse me, they own calls in Tesla. They bought them down here. So clearly they're swimming in profits and they wanted to lock profits. So they said, how can I put my asset to work? I said, well, you can sell this week's, calls up here and collect hundreds of dollars. Why wouldn't you do that? That would be a way to lock profits. Imagine somebody would pay you hundreds of dollars for them to buy your calls, your shares from Tesla from you up here. And if you own shares or if you own calls, that's an easy way for you to lock profits. Just collect money that will likely die this week in your favor. Okay, X, US Steel. So I have history with US Steel. Last year, believe it or not, last year? Yeah, whenever it fell under $5. So under 4. Well, maybe it was the pandemic year. Anyway, I sold $9 puts in US Steel. The stock went to under 5 and they did not assign me shares because there was still time on the clock. I'd like to meet that trader. I ended up making money. I couldn't believe it. Anyway, so not a good place for me to get long. They lost a neckline that looks like a complex head and shoulders, whatever you want to call it. Look at it. Chop, 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 chop. Bounce, 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 bounce. Boom, lost it. And now they're trying to recover it. So I think between here and 22, there are a lot of sellers lurking. So if you're fast enough, you can get in and out inside this, fine. If you're looking to get into an investment, there's a risk of, do I have lines? No, I don't. Oh, that's because that's not the place to do it. I forgot what ticker was here. Anyway, so what you don't want is it comes to here and it hits resistance and then it fades back to here. So beware of the resistance in here. Beware of losing footing here. If you lose this, you're going to 12. Guaranteed. If you lose this, you're most likely going to 13, 12, 13, with a lot of support at 16. So it won't be a straight shot, but it will be bleed down there. Arguably already lost a neckline and you're pricing it out. And the neckline has potential of almost $9 to $10. So arguably it's got a destiny below 12, but let's just give them benefit of the doubt that they can recover the neckline pretty quickly. If they can't and they fade back to here and they lose this, they're on their way. I would not get long. Good support at 16 though. All right, I think Tesla was in here, right? I'm pretty sure. Okay, what's next? Hello. MVIS? Do I want to look at MVIS? That's the self-driving technology, right? Microvision? Yeah. So I'm not a fan of a chart that does this. I don't care what kind of company it is. Do they have income? They barely have any income. Yeah, not for me. I mean, it could be super fantastic if you didn't book profits on an up 20% day, or if you know the technology and you totally believe in it long term. And I'm not talking because you feel like it, because you actually know about it. It is, I mean, it's an ugly chart, any which way you slice it. So you say you have a put for 250. You have a put sold or bought? You bought a put and it went against you. The stock rallied 20%. So your put is toast. I don't know what that is. Oh, so you bought a put for February 4th. Yeah, it doesn't matter for when it's for. On a day where it's up 20%, that put is severely hampered. Yeah, it's worthless now. I don't know when. Are you asking me a question? That would not be a put I'd buy. Let's put it that way. Okay, so next. Sadie's asking, do I give entry and exit trade signals? So if you're looking for a trade alert system, I share trade setups with full-blown videos. I won't tell you take this trade and exit here because A, I don't know your portfolio. How do I know when it's appropriate for your portfolio to exit this trade? For me, I can make my own decisions. I can tell you where the risks are, what the strategy is, 5 different ways of doing the trade. I can't tell you what's appropriate for you because I don't know you. I don't know your account. I don't know your expertise. I can share the opportunity, share what I would do. I would tell you this would be mine. And I would tell you I book early and I set an exit plan. Or sometimes I say, I don't plan on defending it. I will take the shares if it goes against me. So if that's what you need, fine. If you need somebody to say book here, that's not me. But if you come to me and say, hey, I took this trade, what do you think of it now? I may give you my opinion if you're in my chat room.
I mean, what you do share are support and resistance levels
Absolutely. On a
and
daily
trends.
basis, I share every piece of information you need to manage your risk based on super strong charting skills. Yes. And I offer, that's why I spend 2 hours every Sunday doing what I do, because that's your chance to come in and say, there's a box that you can ask a question or say thank you or whatever. So it literally takes me like 5 hours every weekend for me to do this stupid table. And because it's important for people to get feedback on the charts they care about. So this is where you go in and tell me, I want these charts, and here's my question. This is not the form that, but I do have a form where you ask. So yes, this is your opportunity to ask, hey, I took this trade, I'm stuck in it, or it's doing well, how do I book my profits? Or hey, did you exit this trade? I may say I never took it because I can't take hundreds of trades. I would need a computer just to manage them. So sometimes I say this trade is not for me, even though it is a viable trade. Sometimes the trade is a request from somebody. What else? Upstart. So Upstart, I shared a trade setup in July, and it worked out like a charm. It was right here. Boom. So all along here, people say, how about now? How about now? No, 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 no. And then I shared one here. The next day, it went up 17%. The next day. And then if they didn't, I didn't take it, but I shared it with full video. If they took it and they didn't book it after a 30% rally in 3-4 days, you don't need my permission to book. So if somebody took it and rode it all the way back to here, that's bad risk management and being too piggish. You can assume that every time I get a 15% win, I'm booking. Today I booked a 180% win, and it was not enough. I still left money on the table, and I'm okay with that. Tomorrow morning I may cry about it a little bit, but I'm okay with that today.
I think most people here would be satisfied with an 80% win.
Yes, but it's annoying to see it happen. But
right.
if you're mature about it and you know you're in it for the long run, these things will happen. They're unavoidable. So if you go after nailing every entry to the max and every exit to the max perfection, you're going to get frustrated and you're going to quit. In the long run, if you play the right attitude, if you use the system consistently, then you will make fewer mistakes. Like, I knew that this was a quiet period. This was a volatile stock. It wasn't going to last. Boom. And then when it came back down, it was back. I waited until it went back to the place where we did it the first time. I was like, okay, we can repeat it. And then explosion. So if we entered and we got a 28% rally, 27% rally, and you don't book it, you got nobody to blame but yourself. You say, you know what? And by the way, a 20% rally in the stock is a much bigger win in options. So your option probably quadrupled if you just bought a call and you don't book any of it. I don't understand that. That's the mentality that brought us to this problem. Out of the pandemic, the rally out of the pandemic was just as idiotic as can be. I cannot believe we did what we did, but we did it. And that's the payback. That's the payback. This was ridiculous. This is ridiculous. Somewhere in the middle, we should have had the truth, and it didn't happen. And that's also for the, unfortunately, caused the pain in the IWM, because most of these stocks, like Upstart and Palantir and all of that, they live in IWM, the small caps. So they got obliterated, unfortunately. So the rally out of the pandemic. So the world was perfect. The world stopped working. Okay, that makes sense. The world did not come back to life for a long time. And suddenly the world is so much better with COVID. Didn't make sense. At least they spent a year thinking about it. And unfortunately, boom, they fell below it. Now that whole year worth of transactions is lurking above us as resistance. So now the hard work comes to trying to slice through all this volume. Look at this volume. Whoa, that's a lot of work. That's why
Yeah.
you have to book profits and fix trades on the rallies. You're not guaranteed you're going to be slicing through it. These are not normal. Anyway, I don't want to depress anybody, but you should be very pragmatic with your approach to trading, is what I'm saying. I missed out on some upside today, and so be it.
Yeah, that is great advice right there. So, okay, let's for all of you who are, I know we got some people on YouTube, some people on Zoom, some people on our other webinar landing page. So, show some love for Nick. Throw some likes on the page. Subscribe to the Benzinga YouTube channel if you haven't already, and we're giving you 50% off. So you can trade with Nick every day, all day. Ask him any questions you want, any ticker, any calendar spread, any, all of the complicated stuff or simple stuff. If you're a beginner, you're just starting out, we're here for you, or to add another tool in your tool belt if you are experienced.
It's an open classroom at your own pace. So if you don't trade, take every video you get every day as a lesson, because I can guarantee you in the video, I approach the puts and the calls I discuss from the beginner standpoint. So I don't start talking. I redefine what it means to sell a put and redefine what it means, what do I need in order to win, and put it in plain simple English. What are my odds? And what are my pitfalls, potential pitfalls, and what would get me out of the trade and why I took the trade, of course. So maybe you don't agree with the trade, but at least it serves as a lesson. And I suggest for the newcomers to just listen and take notes and see if you can learn and take paper trades. And this way you're not blindsided by saying, oh, I didn't know this happens. So take a paper trade and practice with fake money. And then once you have command over it or confidence that, okay, you get the concept, you've practiced with a paper trade, maybe hopefully on a platform if that's available. If not, no big deal. Then I would try one contract. So one spread, one contract, like sell one, buy one in an order, see how that works, and close it right away if you want. Just practice. This way, the maximum loss would be like $400 versus a huge loss. You have to start somewhere. And if you're in it trying to make a $5,000 monthly income, that's not realistic right away. You have to practice and be realistic with the expectations. I get the worst feeling I get is when somebody new joins and they're like panicking. Where's the trade? Where's the trade? Where's the trade? Where's the trade? That's not the right attitude. The trades will come. Where's the fire? Why is it like you need like 10 trades today? There's a trade every day. There's a trade available every day on any ticker you want. But that doesn't mean I have to take it.
And to answer Tim's question, how can we get trade insights during the day, as we can't be glued to the laptop all day long if we're working full time elsewhere? Is there any app or SMS of the trade? You can sign up for SMS alerts, Tim, but for a lot of these, since these are swing trades and we're all about logical triggers, you can actually go back at the end of your day and watch this full video and be ready to go for the next day. And you have 2 hours of charting every weekend, so you can study, you can set those alerts on your system and be ready to go throughout the week. So as long as you can get away for a 15 to 30 minute lunch break, you can trade. You can do this, and then you can also touch base with Nick. Even if you're on later at night, Nick is 3 hours behind Eastern time, or he's on at 9 a.m. Eastern time in the chat. So just to reiterate, you can just scroll up here like he has this video on Nike and eBay here, as well as his longer videos on the weekends. So you can absolutely take advantage of these trades, even if you're working a full-time job.
Just to answer the question in that video right there, in the video, I say I probably wouldn't do these 2 trades today. So they're available tomorrow with the same parameters, maybe slightly different, maybe even a little bit different, better. Like if the stock market gives back some tomorrow, they would be an even better trade. So I say that in the video. Like there's no rush to take. First of all, I wouldn't take both. Second of all, you know, tomorrow they might be available with the same parameters, if not better. So here's the setup. Work on it. See if you believe in it. Double check it. The next day, go at your own leisure. See if they are acting the way they're supposed to. And if the video levels are still good, then you take the trade or you don't. So my ideal trade is nothing that I can go in and out. So the trades I mentioned earlier here, those are for people who are in the chat room. So I show them 30-second charts and 15-second charts. Nobody sees this stuff out there. So you get an advantage for really fast trades. So you see the breakout happening before most people because they have a 1-minute chart or a 5-minute chart. So for us, 15-second charts are here, 5-second charts are here. So how fast do you want to be? But that's not my goal. This is for somebody who's there and likes some fun and some fast moves. But the goal is the write-ups, the 15-minute write-ups, they're static. They work for 3 weeks, 2 weeks, a month, 6 months sometimes. So there is a little bit of everything for everybody. For whatever speed you're at, my trades are adaptable. So if you have a full-time job and you can only trade once or twice a week, fine, perfect. And if you want to pop in at any point in time during the week to say, hey, I saw the write-up, I'm not really sure, is it still viable? I'm afraid of blah, blah. We'll discuss it.
Absolutely. And well, Nick, thank you for taking time out, especially when you're feeling a little under the weather. And CG's asking, is the chat in Benzinga or a different platform? It's in Benzinga Pro. So this is the Benzinga Pro platform at pro.benzinga.com. And options mentorship with Nick Shaheen is the highest tier subscription of Benzinga Pro, and we're giving it to you half off today, so you're basically getting the mentorship for free. I mean, you're literally paying less than we charge for the essential plan, which is the middle tier without the mentorship. Normally you would just get all these other tools without the mentorship, but now you have Nick, you have over 100 charts on the weekends, live trading 8 hours a day, daily trade videos so that you can swing trade profitably even if you have a full-time job, and you'll actually learn how to trade with technicals and fundamental theses.
That chart you see right there, no, that chart right there, if you just traded that chart today, you made a bundle, because that was the breakout in the S&P from the morning. Clean line makes for a nice breakout / trigger. NTNT, no trigger, no trade. Remember, first started that? So right. If somebody waited for a breach of that, and they breached it and they came back and touched it and boom, gone to the moon. So if you did that, you got from 446 to 451.5, I think we closed, 451.6 or whatever. So you got $5 on the S&P. So if you bought the S&P, you made money. If you bought calls, you made really big money. So what's that worth? One trade, one day, all by itself. And that's not the goal of this program. This is bonus. I do this out of my own free time. So if you can't be minute to minute, but you just happen to pop in, this trade unfolded in minutes. So I promise you the content is there. And I didn't know you guys were throwing in the Benzinga Pro. That platform is insanely powerful.
Yeah, I mean, normally you'd have to pay this much just for the mentorship or just for Benzinga Pro, but with this, you get both of them together.
This Benzinga Pro, I'm still a novice at it. In fact, one of my to-dos is to go in and do better scans so I can find more breakouts like the one you're showing on your screen. Right now, I'm confined to what I have already on my screen, unless somebody says, hey, check out so-and-so is breaking out, then I'll add it. Like the other day, JD came from one of the Benzinga Pro teammates you have. So I want to use Benzinga Pro to improve my scanning ability to, on the fly, have something working for us on the side to catch breakouts for fast breakouts.
Yeah, this new scanner that our developer Tom and I'm sure some other developers built too is pretty cool. Where you've got the 60-second price spike, so I could just say, oh, only show me stocks that are spiking 0.5% in the past 60 seconds, and then you could vary that by market cap, float, fundamentals, you name it. So there's
Wow.
really a lot that you can do here on the
Yeah, that's
scanner.
what I need. That's definitely what I need because I'll put a cap. I don't want to mess with tiny stocks. I just want the big guys. Tell me who's breaking out so I can jump on it if I can. If I can't, I'll just let it go. But at least we'll have somebody looking out for us. That's cool. Okay, you got me going. I'll do that tonight or tomorrow.
Yeah, what's the minimum market cap you're looking at?
I don't know. I'll probably put 5 billion at least.
Okay, yeah. So yeah, I just throw in 5 billion there. That narrows it down a lot, obviously, because it's a 5 billion market cap company that moved at least 0.5% in the past 60 seconds.
Yeah, I already see a Generac that I like. Suncor was the first stock I was assigned because I sold a put and it closed at the money, and it was a happy story. I was assigned on Friday, so the contract expired on Friday. I woke up Monday owning 2,000 shares, and the stock was up $1. So I made $2,000 on the open. In addition
Nice.
to yeah, that was lucky, but it was nice.
All right. Well,
Okay,
Nick, I just got to say thank you again, as always.
you're
Just to
welcome.
reiterate, live trading, 8 hours a day, daily swing trade picks with analysis videos, weekend charting sessions with over 100 companies, and a request form so that you can request for Nick to cover any company. And you get all of the Benzinga Pro tools so you can trade like a pro with the best tools at your fingertips. So that code should be in the chat there. So use that. And you can always reach out to me at jonathan@benzinga.com. And I'll throw that in here one more time. So thank you, Nick. It's been a pleasure as always.
Yep, definitely. I appreciate you organizing this. I appreciate your help. The whole team is insanely nice.
Awesome.
All right.
Well, yeah. I guess we'll see you tomorrow morning then.
Yep, definitely. See you tomorrow.
All right. Take care,
Later.
everyone.
Bye.
Bye. For all of you who are still on here, it's jonathan@benzinga.com. And then making sure that's in all of our different chats. Awesome, CG. We will see you tomorrow morning. Throwing this in here one more time at benzinga.com, as well as the link to the 50% off. That's good through midnight tonight. So don't miss out on that 50% off. Any last minute questions about the subscription or anything about the platform, I'd be happy to answer that while I'm still on the stream here. Just pasting some links. All right. If not, have a fantastic day, fantastic evening, and we will talk soon. Thanks, Antonio. Thank you, CG. Thank you. Let's see who's here in Zoom. Jason, Chuck, McCall, Sati. Awesome. All right. Have a great night. And everyone who's still on here, I'm just throwing those links in there. Go ahead and email me if you have any questions, or I'll throw my phone number in there as well.